Good day, everyone. On behalf of Asian Markets, we welcome you all to the 3Q FY21 earnings conference call of Elgi Equipment Limited. We have with us today Mr. Jairam Varadaraj, Managing Director, representing the company. I request Mr. Jairam to take us through an overview of the quarterly results, and then we shall begin the Q&A session. Over to you, sir. Thank you.
Thank you, Kamlesh. Good afternoon or good evening, ladies and gentlemen. It's my pleasure to be with you this evening. I hope all of you are safe and sound. Families are safe and sound. I think we have done an outstanding job so far as a country to bring us to this level. And I hope that with the vaccine and everything, we'll be in much better shape going forward. I would like to give you a brief overview of our quarter performance. Typically, I look at the consolidated numbers, compare it with the previous year, same quarter. But because the previous year, this year was a special year for various reasons, I will also look at a comparison between, I think it's also relevant to look at the Q3 versus Q2 of this year. So comparing Q3 of current year with the previous year, our sales was higher by 18%, and at the EBITDA level, we were higher by 93%. So just give me a minute. Just give me a minute, sorry. So, in terms of reconciliation, our EBITDA compared to last year should have been about 957. As opposed to that, we were at 599. The difference is about 358 million. So the primary reason for us in this particular quarter has been our contribution has dropped. As you may know, from October onwards, there has been a very volatile and very frequent change in metal commodity prices. We could not react fast enough with our price increases because the volatility was very high. At the contribution level, we lost about 145 million. Employee cost was higher by 55 million, but that's primarily because of exchange and restatement of our foreign employees. Michigan Air employees, who were not there in the previous quarter of Q3 of previous year, have been accounted now because we did the acquisition last December. And the Europe initiative cost a little bit of increase. So these were the reasons. Nothing significant in terms of either headcount increase or compensation increase. And in Q2 of this year, Q2 of this year, we had, I'm getting carried away. So compared to Q3 of last year, we had 85 million of other fixed costs in savings. So overall, we were able to contain it. The biggest challenge was the contribution level. We lost quite a bit of margin. Going to Q2 of comparing ourselves Q3 and Q2. Just give me a minute. Let me pull that. Our EBITDA was 599, 600, and the explanation that I gave you was for Q2. Let me do the explanation for Q3, please. Can you go back? So our EBITDA was 599. Our EBITDA should have been about 670. The primary loss has been employee cost, and like I explained to you, the employee cost is because of addition of Michigan Air, addition of the Europe Industrials, which is an initiative that was not there last year, and the forex impact of restatement of our employee cost. So while we had a great opportunity in Q3 because of an 18% growth in the top line, we lost that primarily because of the volatile material cost. But things have improved. We have responded to price increases for correcting for the raw material price increases. And we've started seeing the results in January itself. So I think the rest of the quarter of Q4 should be far better in terms of at the contribution level. So moving on to a business level evaluation or a statement. Typically, I start from Australia and work across the globe. Australia was a very, very strong year for us compared to Q3 of last year. We grew by almost 60% in Australia on the back of some very strong orders across the board. Coming into Southeast Asia, it was muted, roughly similar to last year. There was no growth, but it was flat. India, like as India said, India has grown quite significantly for us, close to about 20%. The Gulf was a challenge. Gulf dropped compared to last year. Europe was a very positive performance. We grew by almost 60% in Europe as well. America was also strong at around 17-18%. So, and our automotive equipment business also grew by 18% compared to those. So all around, except for a few geographical pockets, our businesses grew well. But we believe that we have gained some share in our market in various geographies. In India, it's very difficult to say because we don't have market size data, whereas in the rest of the world, at least in some parts of the country, we have. So overall, it's been a positive Q3. I think we could have, if we had not had the volatility, we would have definitely done very well, far better. But I think we have corrected it. We have taken control over the situation. I think Q4 should, on that count, Q4 should be quite positive. So this is on, so if you look at our share of business, India in Q3 has come back. It is now 53% of our revenue compared to, and 47% of the rest of the world. But year to date, India is still 47 and the rest of the world is 53. So when we started this year, Q1, India was quite bad. The rest of the world really pitched in and the percentage is high. So now India is coming back into stream. So the percentages are shifting. Going into our net debt position, our net debt is 109 crores. We've had a substantial reduction in our debt. This 109 crores includes about 11 crores that we got as a IT refund. This is still a mystery refund that has been received. We are still working with the income tax department to figure this out. So this includes that. The same number in Q2 was 149 crores. So we've been able to reduce about 40 crores in this quarter. Just as a trend presentation in Q1, without the IT refund, we were at 205. So from 260, we reduced to 205. From 205, we brought it down to 150, 150 to 109. So we have good control over our raw material and our receivables. But international business as well as our import has been a big challenge because As you must have all heard, containers are becoming a problem. Freight costs have gone up. Shipments are getting delayed quite significantly. Many of our vendors are finding it difficult to keep up because of raw material challenges. So there will be a phase that we will be going through. There will be an increase in inventory we have to do it as a means to protect against this temporary, what we believe is a temporary volatility. Maybe it will last 2 to 3 months and it should come back to normal. So that's an overall presentation of our finances. I'll be happy to answer your specific questions. I apologize for that initial mishap where I was floundering a little bit between quarters. Sorry about that. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi from Spark Capital. Please go ahead.
Hi, sir. Congrats
Hi,
on
Ravi.
the set of numbers.
Thank you.
First, you had mentioned in the press release that the outlook seems to be good in the domestic market because of good traction seen from the union budget, etc. So what kind of growth we can see? Which are the sectors which are likely to drive growth in the Indian markets, especially infra-driven, and what kind of growth can we expect for the domestic market? First, within the broad view.
Well, like I said in the previous Q2 presentation, Ravi, the growth that we are experiencing in Q3 and we're continuing to do into Q4 is on the industrial side across all industries. There is I would not say there is one specific industry that's disproportionately high. All of them are back in the market and looking at capacities. The infrastructure emphasis of the government in terms of roads and construction is also giving us, on our portable range, there's been a good traction. We are beginning to see that across most of the portable categories. So these are the two areas that I see. As far as growth going into next year, it's very difficult to say because this was a distorted year. If we continue down our trajectory, our revenue for this year will be equal to last year. Effectively, what that means is that we have done 12 months revenue in about 9 to 9.5 months. So if you look at that itself is a growth of close to 20-odd%, right? Now, growing again, if you look at it, that growth has happened partly in Q2 and Q3 and Q4. Now, to go beyond that is a bit difficult, but the fact that we lost one quarter this year, we are going to get that quarter back next year, right? So if I add it back, I think 10 to 12% growth is realistically possible at a very minimum.
Okay. So, I mean, in the last investor meet, when we had met, you had mentioned domestic market kind of might remain kind of subdued. What are the things that you are seeing that it is incrementally positive from, say, last February to now?
From last February to now? I mean, if you look at the last year, besides the COVID thing, if you look at it, October onwards, the economy started getting very sluggish, right? And we were going through a very muted period in terms of demand. Overall, there was a lull in the economic activity. So now it is completely different. It's a completely different landscape right now.
Okay. Got it, sir. And what's the quantum of price increase that we have taken on a blended basis to compensate for raw material cost increase?
Oh, it varies from product to product. It's anywhere from parts to products and different kinds. It's anywhere between 2 to 4%.
2 to 4%. Got it.
Yeah.
And any Chinese imports that might have lost market share, or we might have gained market share, given the fact that supply chains for them also have been disrupted, especially in the piston compressor range. Anything of that sort that we have seen in terms of market share gains even from Chinese imports?
Like I said, it's difficult in the Indian market to talk about market share because there is no collective data that everyone kind of submits to understand the size of the market, right? So it is only speculative that you can say because of your growth and then say, oh, I may have gained market share. So it's very difficult to say. So we'll have to wait to see the results of our competitors, which many of them are not listed. They are private. So it'll take a year by the time those numbers come out.
Got it, sir. Got it. Yeah. Thanks.
Thank you. The next question is from the line of Manish Goyal from Enam Holdings. Please go ahead.
Yeah, thank you very much and very good evening, sir. And very congratulations on excellent numbers, sir.
Thank you.
Sir, I have a few questions. First, on the VRS which board has approved. So just would like to know, no doubt last year you were mentioning that we would probably look to do certain employee rationalization, especially in India. So maybe if you can just give a perspective as to is it VRS is for only India or overseas, and what kind of numbers in terms of employees we are looking and the value, right?
Yeah. So the VRS is only for the Indian market, for the Indian operation, and it is primarily in our operations in the blue collar category of employees. We expect it's not a big number. We expect about 30 to 35 people reduction, and it's going to cost us maybe around 5 crore.
Sure. Okay. And in terms of US, particularly US and Europe market, we had seen a re-emergence of the pandemic second wave. So no doubt Q3 has been very strong for us, but if you can just give us a perspective as to are we seeing any slower growth trends, and also specifically I missed the US performance in Q3. So if you can just dwell upon US and Europe markets.
Well, both, yes, they had multiple waves in those countries, but I think the arrival of the vaccine and the vaccination process and generally people having adjusted to a way of working with protection, with the COVID virus around, business is it's not going down anymore. It is on a return path. So I don't see that as a challenge, and I think the whole world, 21-22, I expect the whole world will have a good year because 2021 was a very bad year. So it's a no-brainer to say that. Yeah. As far as the US is concerned, North America, we grew by about 16%, 15-16%. Growth in certain segments were high, certain segments were kind of flat. Europe grew by almost 60%. Like I said, I mean, in Europe, we are starting at nothing. I mean, there's so much headroom for growth, irrespective of whether the market is growing or going down. The headroom for us is so high. We put the right strategy in place. We had the right team of people. We have the right products. And therefore, we are seeing the results, right? So it is a very deliberate, this is not accidental. It's a very deliberate thing. Australia also is very deliberate. This is a result of many years of work. We are beginning to see that. So it's positive. Yeah.
Sure. And on the fixed cost, sir, we were looking for certain reduction, and now with almost 10 months have passed. So what kind of sustainable fixed cost reduction we can kind of factor going forward for the company, sir?
Well, we don't have a final number on that, Manish, in terms of what will be. See, if you look at Q3, some of the fixed costs has increased, and part of it is also because of the business has grown, right? But if you look at the increase in fixed costs in relation to the increase in business, it's a fraction of what it used to be earlier, right? So we still haven't really done a detailed calibration of what, when things get back, the vaccination has been done, and people are coming out, and things come back to normal. You know, a part of our the way we conduct our business is also a function of the customer, right? Today, a customer is quite happy to tell us, don't come to the factory or don't come to our office. We're quite happy to talk to you virtually. But when things get back to normal, if customers start saying, no, we want to see you, then it changes, right? But we will have to see how best to optimize it. So it's very difficult to say. I'm taking travel as one because that's one big, heavy aspect of our fixed cost, right? Sure. So it's difficult to say, but there are certain costs, like for instance, travel to the head office people going to the branches. These kinds of costs we will definitely save, right? Because we have said, no, we're not going to do that, right? And we're going to use the virtual platform for those kinds of meetings. So, difficult. We are, like I said in the earlier meeting, we have decided to shut down our branches, right? We're already talking to all our employees. So that's going to be a saving. So those are sustainable. So we still haven't done a final tabulation of how the steady state will look like.
Okay, that's one, sir. And sir, you did give the number for India sales at 53% for the quarter. So can I have the comparative YOY number for Q3 last year and also 9 months last year?
Year on, you mean the percentage of LG, I mean, a percentage of India versus the rest of the world?
Yeah, so right? India you said 53. I wanted a comparative number.
Yeah, for the earlier quarter was also 53. Q3 of last year was also 53.
Okay.
Yeah.
And 9 months also, sir?
In 9 months this year, India is 47.
Yeah.
Last year was 54.
Okay. Fine, sir. I'll get back in the queue. Thank you so much, sir.
Yeah. Thank you.
Thank you. We would like to remind participants that you may press star 1 to ask a question. The next question is from the line of Harshit Patel from Equirus Securities. Please go ahead.
Thank you very much for the opportunity, sir. Sir, I had a few queries on our oil-free compressors business. So, sir, how is that business now shaping up for us? In the last quarter, you had mentioned that we had started doing reasonably well, even in the international markets on that front. So, sir, how is that we are scaling up in that business now?
I think the traction we gained in the prior years in India is continuing, and Q3 was also a good quarter for us on that thing in India. And the international traction that I mentioned to you in Q2 continues to remain strong. So, but it's a long path in that product segment because it takes some time. Yeah.
Sure, sir. So, sir, could you give us some idea as to what portion of our revenues would now be coming from the oil-free?
I wouldn't like to share that number, Harshad, if you don't mind. It's too competitively sensitive. Yeah.
Sure, sir. No problem. Sir, my second question would be on the motors front. You had earlier highlighted that we were doing some validation trials for the developed markets, both USA as well as Europe. So, sir, have we now started supplying compressors with our own motors for those markets, or is it still more of an Indian thing?
No. The regular supplies have started for the Indian market quite steadily. The motors are, we don't want to take any risks. So the validation process for doing it in Europe and America will take some time. So it will be probably down the second half of the next financial years when we will start seeing more regular supplies with our motors into those markets.
Sure, sir. So, sir, just a small follow-up on the same. So, in India, how much portion of our compressors have now our own motors?
Oh, I don't have that number in front of me. I don't have it. I don't have it in front of me. Sorry.
Sure, sir. No problem, sir. That was all from my side. Thanks a lot, sir.
Thank you. The next question is from the line of Ritvik from Deep Finance. Please go ahead.
Yeah. Hi. Thank you for the opportunity.
Hi, Ritvik. Sure.
So I have one question on employee cost. If I see the consolidated number, it's up 10% sequentially from Q2 of FY21, and standalone is flattish. So does that imply that the entire employee cost is increasing due to Europe investment?
Q2, you're comparing Q2?
Yeah, correct. Of current financial year.
Okay. So what happened in Q2 is there was a huge subsidy both in Australia and the US, right?
Okay.
That is not there in Q3. Yeah, that subsidy was close to 83 million.
Okay.
So if you add that, it almost becomes level.
Sure. Okay. So that explains the entire part of it. Okay.
Yeah.
So going forward, should we consider this 110 crores as a stable run rate going forward, since the subsidy would be gone completely in the coming quarters as well?
Yeah. For this year, yes. The next year, like I said, we have a strategy in Europe which we paused because of the COVID situation. We will recommence that strategic initiative. So there will be an increase in people cost as a consequence of completing that strategic initiative. Then there will of course be some normal increments and all that will come in, right? Because we had frozen increases, we had frozen all kinds of stuff this year. But the team has done an outstanding job, so it is only fair that we reinstate those practices that we had before. For next year there will be an increase. Yeah.
Right. So this is the 25 million euros that we plan to invest from FY22 onwards over 3 years.
No. We started in 1920.
Right.
Right. So we paused it in this year, right?
Sure.
Now we're gaining traction. We have we believe that we are past this COVID now, and then slowly we are getting back to that original plan. Yeah.
Sure. Okay.
Yeah.
And sir, in the revenue split, could you give us the figure for Europe and USA? What would be the percentage for 9-month FY21?
The total, I don't know the percentage of, Europe as a, or FY21, the whole year, I don't have it in front of me. So
okay.
I would say Europe, I have it only for, I can't say it for the whole year. Yeah.
Okay. 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 And sir, sorry, hopping on the Europe investment again, could it be about what is the kind of run rate that we are looking at, from FY22 on an annual basis for employee cost increase?
No, sorry, I didn't get your question.
So we mentioned that Europe investment will restart from FY22 because we are seeing good traction in that region. So what is the, if I'm not wrong, our earlier plan was to invest about 25 to 30 million euros for 3 to 4 years. So
25 to 30 million. 25 to 30 million would be the loss over a period of 4 years that we will incur in our initiative. That's what I said, right?
Okay.
So, in terms of increase in people cost next year would be about 13 to 14 crores.
Okay. That's on a annual basis.
Yeah.
Okay. Okay, sure. That answers my question. Thank you and all the best, sir.
Thank you.
Thank you. The next question is from the line of Kishore, an individual investor. Please go ahead.
Hi, Giri. Good evening. I'm great to have numbers again.
Thank you.
The question I had was more a generic or forward question.
Sorry to interrupt, Mr. Kishore. So this is the operator. So there's a disturbance coming from the background, sir, from your line.
Okay. Is it better?
Yeah.
Yes, sir. You may go ahead.
Yeah. So question I had was more to do with our overseas operations and the forward-looking view on that. So 3 parts to the question. One is, what is the relative margin profile across the different key markets that we've gone into? The second part is, how much of our forward-looking, growth is going to be driven by inorganic, and what is the competitive response that we're seeing there? So are we, for example, facing any, difficulties in moving forward down that path, or, what is the competitive response that we're seeing there?
I will answer the question to the extent that I've understood, then you can correct me if my understanding was right or wrong. In terms of profitability, like I've always maintained, at the contribution level, our markets outside are far more profitable than India. I don't want to get into the differences in percentages, but they are significantly more profitable. It is at EBITDA level, of course, India is more profitable because we have a bigger presence in India, and and therefore we are able to absorb our overhead. Whereas in the markets that we have entered into, our overheads are high by virtue of people costs there are high, and we are in the trajectory to gain our size there. So it will happen, and we are already beginning to see that happen. In terms of our acquisition, we don't have anything on the horizon, or we have not looked at anything in our compressor business. Our acquisition strategy is about acquiring customer acquisition. I mean, wherever there is an opportunity to acquire customers. So it's distribution companies, service companies that have relationship with customers, who own the relationship with customers. Those are the ones that are attractive for us. We are not looking at buying any compressor company, right? So it's right now our goal is primarily, at least for the next couple of years, we are going to be looking purely focused on organic growth. So I don't see any acquisition in the horizon.
Got it. I think that's very clear and helpful. Thank you.
Yeah.
Thank you. The next question is from the line of Ranjit Shivaram from ICICI Securities. Please go ahead.
Yeah. Hi, sir. Good afternoon, and congrats on good set of numbers. Given the scenario, it's a stellar performance.
Thank you.
Sir, one thing which during the lockdown period you were very apprehensive regarding investing into people and ramping up our domestic operations. But now that we have a very good visionary budget in which the infra spending is increased, so would you go back to the drawing board in terms of your domestic strategy by investing into people and looking at improving market share? Will there be any change in their approach now, given the scenario?
Absolutely. I think that absolutely. I mean, we even while we had our the concerns and caution with COVID, we did not stop our strategic planning, our go-to-market strategy refinement. We continue to work through it, and we are now at a very advanced stage of, significantly shifting the needle in India. So, to the extent that strategy has to be supported by incremental structures in different geographies of India, we will certainly do that. But it has to be done after ensuring that all our efficiency possibilities are extracted, and then we will do that. Absolutely.
And are you seeing on the ground traction in terms of construction companies ordering has improved, or the inquiries have come out? Because
yes, contractors, construction contractors, definitely yes. Yeah, you're seeing that. Yeah.
Okay, and in terms of our we get to hear a lot of anti-China sentiments running throughout the globe. So, will there be any advantage for our Australian operations, especially that one geography where there is still a lot more resentment towards Chinese? So, are we seeing being one of these beneficiaries, and do we want to actually capitalize on that and strengthen our market share, or is China very relevant player there?
I think the sentiment on China plus one strategy on sourcing, these are all things that are floating around. But like I said, for certain category of products, the switching costs are very low, and they will switch. And I think we are beginning to see that switch happening, and that's why some of the segments in India are beginning to see a sudden onrush of significant shift in the business, right? But for certain other categories of products, the switching costs are very high. You can't switch that easily. So that will take some time, and definitely we will ride that wave. But we don't want to be the ones that are, make it look like we are benefiting from somebody else's agony, right? We like to play in the market. We don't want to go and sell ourselves as an option for a Chinese player. We'd like to sell ourselves as a good option, period. Yeah.
Okay. And sir, our one of the new launches which we had showcased in our last analyst meet also, that oil-free compressor. So we had also put out a notice that we participated in one of the exhibitions. So how have been the customer feedback, and are you seeing a lot more acceptance to that product?
Absolutely.
What is the outlook out there?
Yes. It's positive. I mean, the product acceptance has been very, very strong. Customer experience has been good because many of our reputed blue chip customers are repeating their purchase. That is for any product, repeat purchase is the ultimate evidence of endorsement. So that is happening. We are also pushing the performance of the product. I mean, like I said, this product that we launched is only one milestone. Our goal is to continue to push where both the oil lubricated and oil-free categories merge. So we've been using this period to continue to develop our technology, and we are beginning to see some good progress on that.
Okay, sir. Congrats and all the best.
I think we couldn't meet the expectation or the guidance that your organization had put out at the EBITDA level. So.
Okay. Yeah, yes, sir. You are able to.
Thank you. The next question is from the line of Dhiman Shah from One Up Finance Consultants. Please go ahead.
Hello.
Yes.
Yes, sir. 2 or 3 quick conjoined questions. In terms of market, acceptance and, ability to offer solutions, would you say you are equally placed in all the geographies? That's question number 1. Question number 2, are there still some low-hanging fruits in terms of, our ability to either exploit somebody else's weakness or completely bereft of, any offering? For example, let's say if somebody is not able to offer oil-free screw and you have an excellent solution, maybe that gives you a ready-made market. And as a corollary to that, would you, as the overall piece moves towards the vision laid out by the management, would you say that, roughly about, 10 to 15% growth would be ideal, along with 15 to 20% spares and AMC and rest of the paraphernalia? So if you can even highlight some on this. And lastly, in terms of our ability to either on manufacturing side or ability to offer product portfolio in a totality. So be it rotary, be it recip, be it a dynamic, be it a Sentry, all the categories, are we missing out on some large size opportunity which can be filled in the future?
Okay. There were multiple points. I will try to answer them to the extent that I remember each one of them. To start with, in terms, your question was, are there any territories that we are where we are not present? Yes, we are not present in China. We entered China. China is the single largest market for compressors. We operated in China for almost 10 years, and we made a deliberate decision to step out of the market, because for an Indian product with an Indian brand, the expectation on price was just not viable. So we had to completely redesign a product which we felt was not a prudent use of resources when we had opportunities, a lot more profitable opportunities in Europe and Australia and America. So we are not playing in that market. So to that extent, we are not present in all. The second question was on aftermarket, whether the growth we should be content with 10 to 15%. 10 to 15% being content is in a specific context. So if you look at in the Indian market where our presence is quite strong, and depending on how the Indian economy grows, assuming it grows at 5, 6, 7%, if you grow at 10 to 15%, then I'd say that is good, right? But 10 to 15% is not good in nascent markets that we are present. Nascent for us, but developed for everyone else. Like Australia and in Europe and in the US, we have to grow at a much higher percentage, which is our aspiration, and we are looking towards doing that. So it is not 1% across all markets. It's different for different markets. And aftermarket, the whole purpose of this game, if you had read our MD&A in our last annual report, one of the primary purposes of being present and going through the challenges of this market is the profit in aftermarket, right?
Perfect.
So aftermarket, 10-15% is then we might as well shut shop and go home, right? So the opportunity is to be at around 30-35% on a steady state. So you create an install base in all the markets, and that install base gives you the profitable aftermarket, right? So that is really a foundational strategy of the company from a profitability point of view, right?
Sir, here, if I can just interject, does this also, include any possibilities of even catering to install base which is not ours?
Well, some of the distribution companies that we own do third-party service, right? But is third-party service a strategic priority at a company level? No, it's not at this moment, right? Because we need to build install base and service our customers effectively, gain the aftermarket for our machines, and reach a certain steady state before you get distracted by opportunities outside your domain, right?
Perfect.
So it will come later, but not now. And I think your third question is, are there
any overall gaps that you still feel, you need to...
Product gaps are, of course, there. We are continuously working towards building them. We are not going to make one Hanuman leap and cover all of them. And even if we develop the technology and the products, getting them into the market and stabilizing them, it takes time. So we have a roadmap of what priorities we want to do, and we are progressing along down that path.
So, just to probe on that, would you be more enthused to, complete a dynamic or a Sentry portfolio, or, existing base of oil-free screw with and recip and rotary suffice?
So you obviously know compressors. So if you look at centrifugal, we are doing some business there. It is a priority. We have the technology, and we are working on developing something there. Because those applications are very different.
Correct, sir. Because mainly it is the impeller and the casing and so on and so forth.
Yeah.
Great. And lastly, if you can, are we also eyeing the huge CNG opportunity thrown in the local markets with,
No, we are very clear. We are very clear we want to play in the air business. We'll get to those exotic fluids at a later stage.
Perfect, sir. Perfect. So very kind of you to have answered. Thank you so much.
Thank you. The next question is from the line of Manish Goyal from Enam Holdings. Please go ahead.
Thank you so much. Sir, just would it be possible to give a rough idea as to how much infra should be contributing to our compressor sales in India? Like even you mentioned that portable is doing well from the construction activity, including roads. While I believe railways is also seeing a uptick on the budgetary allocations. So broadly, if you can give us a perspective as to how much would be infra-driven revenues.
I don't have the number in front of me, Manish. I'm just venturing a guess. For us, portable compressor is not a significant. Even globally, portable compressor is about 10% of the total compressor business, right? So if you take our consolidated number, it's probably at around 5%, right? 5 or 6%.
Okay.
But this excludes water well. Water well is a different story.
Yeah, in fact, my next question was on water well.
I was wondering why you forgot about that. But.
So, how is that market behaving, sir? And in terms of our product launches and market share, how is it?
The market right now, the demand for machines is abysmally bad, right? There was excess capacity combined with all this COVID fear, and rains were good. There was no immediate pressure, so primarily there was excess capacity. Drilling rates went down, so there's been a lull. But we expect that this calendar year, we will see some uptick because we're talking to customers. Many of them have old machines. Their machines are coming to their end of life. So there will be investment. Our new machine is working outstandingly well. We've got them out running with very key reference customers, and the feedback has been outstanding. So we are well set. So once we have completed all our validation and trials with all our customers, we will be launching that product, and we hope that will coincide with when the market uptick happens. So we ride that day. Yeah. But it's a long haul because from 70% market share, we went down to 20%. To climb back, it's going to take time because competitors are also strong.
Okay, sure. And sir, on one housekeeping question on the debt number, you did mention the net debt at 109 crores. Would it be possible to share the gross debt number and the cash? Just want to get are we looking to reduce the gross debt number this year? What will we end up with?
Well, we have our gross debt is 400 crores and our cash is 300 odd crores, right? 400 odd crores and 300 odd. That's the ratio, right?
Sure.
So 404 and 295 to be precise. Yeah.
Okay. Thank you. Thank you so much.
So we can get rid of the debt, but most of our debt is in foreign exchange, and it is at very low interest rate. There's really no need to get rid of it, Manish.
Sure. Thank you so much.
Thank you. We would like to remind participants that you may press star 1 to ask a question.
Mr. Jai, Kamlesh here. I just wanted to have one understanding. Sir, about the US market, can you just elaborate on how Pattons has done in the overall market and the medical compressor business, how it has been performing there? That is one. And second thing, are we covered in terms of most pockets of the US market, or there are many more pockets where we need to enhance our distribution reach, and that's only is going to happen over a period of time? Just you can share on that.
So Pattons was a bit of a challenge. It's flat. It has not done. It has not grown like our industrial business.
Mm-hmm.
Portables is also flat because the rental market and construction activities were low. Our medical business did really well, obviously because a lot of investment was happening in hospitals, and that's our primary customers are hospitals. So that's done well, right?
Mm-hmm. Okay. And in terms of the geographical reach, if you can just...
Geographical. Oh, there are quite a few. I mean, America is a huge country in terms of our presence with distribution. So if you take it by distribution coverage on one axis and the quality of distribution on the other axis, we have a lot of ground to cover, right? If I take the strength of our distribution in specific markets, there are only very few markets where we are very strong with distribution, right? So there's huge opportunity to improve.
Mm-hmm. Okay. So it will be a calibrated kind of expansion that we are looking at, or?
Absolutely. So like I explained in one of my earlier calls, we have a very strategic definition of our priority geographical regions in the US, and our disproportionate focus is on those regions, how to grow those regions, how to partner with distributors in those regions. And Michigan Air was a deliberate acquisition because Detroit is in the top 5. Yeah?
Sure.
So we'll continue to look at very focused attention where the opportunities are the highest.
Yeah. Okay. Yeah, Malika, you can take other questions, please.
Yes, sir. Thank you. The next question is from the line of Amanjeet Singh from Oculus Capital. Please go ahead.
Yeah. Thank you, sir. Am I audible?
Yes, you are.
So just a small clarification. Earlier in the call, so you mentioned that next year you're looking at 10 to 12% minimum growth. So was that an overall level, or was that just for your India base?
India base.
Current on an overall level?
Overall level, we should be growing at, other than India, anywhere between 15 to 17%.
So blended at company level, 15 to 17%.
No. Other than India, 15 to 17. So blended,
okay, got it.
You take 7.5. This is about 5, 6, or 13, 14%.
Got it. Thank you, sir.
Thank you. Participants, to ask a question, you may press star and 1 now. The next question is from the line of Kishore, an individual investor. Please go ahead.
Yeah. So, Divya, I had a question on the IoT side of things. Is there, maybe not a near-term thing, but in the medium term, is there any visibility of any recurring revenue streams being generated through that side of the business?
Our IoT platform, which is a global platform, is ready, and it's going to get launched in sometime in March, April of this year. We are very clear about our IoT strategy. Providing reports and connectivity is not a value to the customer. We need to figure out how to bring either savings to the customer or productivity for the customer or uptime to the customer. There has to be visceral, measurable monetary value. Otherwise, you cannot monetize your service. So it's a chicken and egg thing. So can we put the machines in? We have back-end algorithms. Once we are able to tap into machines, we have algorithms which can monitor and analyze the performance of the machine and the opportunity to improve the performance. So once we are able to do that and then present that value to the customer, then we will be able to invoice it. So right now, to answer your question, we don't have a revenue model built around it. Right now, our IoT is a pure cost model. We want to get it out there, put the machines in place, start getting the information, and go back to customers with value and then price it.
Got it. So not in the near term, that's in terms of the revenue contribution.
Yeah.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1 now. As there are no further questions, I would now like to hand the conference over to Mr. Kamlesh Kotak from Asian Market Securities Private Limited for closing comments.
Thank you, Malika. On behalf of Asian Markets, we thank everyone for joining for this call. special thanks to Mr. Jairam for providing us an insight about the company's business and financial performance. Sir, any closing comments you want to make?
I'm fine. Thank you, Kamlesh. Thank you for organizing it, and thank you everyone for your patience and participation. Thank you.
Thank you. On behalf of